Welcome back to the deep dive. If you've been watching the markets, it feels less like a well-oiled machine and more like a high-stakes polarized battlefield.
It's a great way to put it.
We're focusing on these critical few days in December 2025, which are just being defined by these huge policy decisions and some really unprecedented corporate drama.
It's an environment of, profound contradiction. We're sitting right on the cusp of the most anticipated, and I'd argue the most certain policy move of the year,
The Fed rate cut.
the Fed rate cut. And yet the uncertainty about what comes after that move is driving just massive volatility across, well, all asset classes.
That's the perfect framing for our mission today. We've pulled together a stack of sources from J.P. Morgan's outlooks to Kiplinger's real-time commentary and some deep economic intelligence from the Conference Board and Mercatus.
Right.
And the job is to unpack this central tension, this near certainty of a rate cut versus the complete uncertainty of what happens next. It's this paradox that J.P. Morgan described as the coming era of multidimensional polarization.
And that polarization is the key insight. You have to keep it in mind. While everyone is focused on the immediate announcement, the market has, it's already factored it in completely.
It's priced in.
It's fully priced in. Futures traders were pricing in, an 87% to nearly 90% probability that the Fed would deliver its third straight 25 basis point cut.
And that would bring the federal funds rate down to about 3.5% to 3.75%.
Exactly. So if the cut itself is almost a guarantee, where does the chaos come from?
From the guidance.
Entirely from the accompanying guidance. The market's focus has completely shifted to the velocity of future cuts. How fast and how deep will the easing go in 2026? If the Fed hints at slowing down, even while cutting rates now, the reaction is going to be violent.
Let's start right there with that monetary move, because that 25 basis point cut is, like you said, essentially locked in. That's the lowest the rate has been since September of 2022.
Right. But the cut is just the ante. The real poker game, as you said, is that forward guidance.
And when we talk about guidance, what are we really looking for?
We're looking at the Fed's summary of economic projections, the SEP, or what everyone on Wall Street just calls the dot plot.
Right, the dot plot. That's where each member puts a dot where they think rates will be.
And that's where the threat lies. The threat is what some are calling the hawkish cut.
Okay, so break that down. A hawkish cut.
It means you give the market the rate reduction it's begging for today, but you kill future expectations at the same time.
So Chair Powell delivers the cut, but his commentary is cautious.
Cautious. Or the dot plot itself shows maybe 2 cuts next year when the market has priced in 4. That would cause a massive, immediate repricing of risk. It would signal the Fed is far more worried about inflation sticking around than it is about a slowing labor market.
And we know this decision isn't being made in some, unified happy room. There's a really unusual public split in the FOMC right now.
That dissent is rare, and it just underscores how tough their job is. You even see it in the little symbolic thing.
Like the purple tie.
Oh, exactly. Chair Powell has been consistently wearing a purple tie. It's a small detail, but it's meant to signal, we are non-political, we are bipartisan, but that neutrality is clearly under strain.
And you can see why when you look at the data they're trying to balance, it's just wildly conflicting.
It's all over the place. You've got the Conference Board's data, the Leading Economic Index, or LEI. It declined again.
And a consistent decline there is a big warning sign.
It's a huge warning sign. It reinforces that view that growth is, and I think their words were, fragile and uneven heading into 2026. So that data is screaming for the Fed to ease policy.
But then on the other side of the coin, you have the labor market.
The labor market just refuses to cool down as fast as anyone predicted.
And that was driven home by that delayed October JOLTS report, the job opening survey.
That report was a stunner. It showed 7.67 million job openings.
When the consensus was, 7.2 million? That's a huge beat.
A massive beat. And that unexpected strength immediately sent the 10-year Treasury yield up to nearly 4.19%.
Which runs completely contrary to what the Fed is trying to do.
It's their central headache. They ease policy to help, say, housing or manufacturing, but that same move could just reignite wage demands in a labor market that's still running way too hot.
That structural dilemma is the perfect entry point into J.P. Morgan's core thesis, this era of multi-dimensional polarization.
It defines the entire playing field. They argue the market is splitting across 3 main dimensions.
Okay, what are they?
One, you've got the equity markets splitting between the handful of soaring AI stocks and, well, everything else.
The haves and the have-nots of tech.
Precisely. Two, the broader U.S. economy. You see this robust corporate capital spending, mostly on AI and tech, right alongside really soft, stagnant labor demand.
And the third one.
And this is the one that's really alarming, a widening divide in household wealth and spending power.
Let's stick with that for a second, because that's the human side of the K-shaped recovery everyone talks about.
It is, and the metrics on this from Oxford Economics are just incredibly sharp. They found that on average, white households added about $85,000 in wealth this year.
85,000, and how does that compare?
You contrast that with Black and Hispanic households, they added on average only about $25,000.
Wow, that's a $60,000 difference in 1 year.
Yeah.
How? What's the mechanism there?
It's really all about where people's money is. It's asset allocation, and it's being amplified by this AI boom.
So stocks versus other assets.
Exactly. White households tend to have a higher portion of their net worth in stocks, so they've captured these huge gains from the AI tech surge. Black and Hispanic households, conversely, hold more of their wealth in their homes, and while home values have gone up, it's been much, much slower than the stock market.
So the AI boom isn't lifting all boats, it's actually widening the gap.
It's pouring fuel on the fire of this K-shaped economy.
And yet, even with all that fragility, we still see these pockets of, well, of bullishness. The Russell 2000, the small cap index, hit a new record high.
That's a really powerful tactical signal. You need to understand why. Small cap firms are incredibly sensitive to borrowing costs.
Because they're smaller, more domestically focused.
Right. Their ability to grow, to refinance debt, it's all tied directly to the federal funds rate. The fact that the Russell is soaring tells you that investors are betting aggressively on one thing.
That lower borrowing costs are coming, and coming soon.
It's a deep, abiding faith in the Fed's easing cycle.
But if we zoom out again, the consensus forecast is still for 2% real GDP growth over the next year. With a slowing labor force, how is that 2% even possible? What's holding it up?
It relies almost entirely on one single structural offset.
And that is?
Productivity gains. Significant productivity gains from all this accelerating AI activity.
So the idea is we can produce more with less.
That's the core thesis you see from groups like Mercatus. Slower job growth won't kill GDP growth if the workers we do have become dramatically more productive because of AI. This makes the entire economic outlook profoundly dependent on tech adoption, not human labor.
Speaking of corporate reliance on tech, we have to pivot from macro policy to some pure high-stakes corporate drama. The fight over Warner Bros. Discovery.
This deal is just colossal. You're talking about Netflix launching an $83 billion cash-and-stock deal to acquire WBD's studios and streaming assets.
So basically to buy HBO and everything that comes with it.
It's an attempt to consolidate the whole streaming landscape. But then things got messy.
When Paramount Skydance launched a hostile takeover bid.
Exactly. The moment that hostile bid was announced, PSKY shares surged 9%. So investors loved the move. This isn't a friendly negotiation, it's a Wall Street brawl.
And the financial stakes, if this thing falls apart, are just, they're staggering.
Staggering is the right word. If WBD walks away from Netflix to take the other deal, they owe Netflix a $2.8 billion breakup fee.
But that's not even the big one.
No. The really eye-opening one is the regulatory risk fee. If the Netflix deal fails specifically because the government blocks it on antitrust grounds,
Netflix has to pay WBD how much?
$5.8 billion.
$5.8 billion. That figure tells you everything. It tells you both companies expect a long, brutal fight with regulators.
And that regulatory scrutiny just got ratcheted up exponentially by the Trump factor.
Right. The president jumped in publicly, saying the Netflix deal could be a problem and that he would be involved in the decision.
And that just shifts the entire risk premium into overdrive. It moves the decision out of the normal regulatory boards and puts it squarely into the political realm. A simple statement like that can kill a transaction. That $5.8 billion penalty suddenly looks a lot more plausible.
We also saw another big policy shift, this one in U.S.-China tech relations, which directly ties back to that AI narrative.
A very big shift. The administration authorized NVIDIA to sell its most advanced H200 AI chips to approved customers in China.
This is a major pivot from the old strategy of just broad denial.
It is. They're moving toward what you could call controlled conditional access. They're allowing the sale of the cutting-edge chip, but there's a huge string attached.
The revenue cut.
Exactly. The U.S. government gets a 25% revenue cut from these sales. That's up from the 15% cut on the less advanced chips.
So what's the calculus there? What's the trade-off?
It's a calculated risk. On one hand, it lets U.S. firms access a massive revenue stream in China. But the risk, and analysts are very clear about this, is that you are potentially accelerating China's own domestic AI capabilities.
Mhm.
It's short-term revenue versus long-term technological competition.
Let's circle back to how the broader market is digesting all of this. The commodity space is showing a really stark divergence right now. Let's start with oil versus gold.
The oil market, frankly, is flashing a huge macroeconomic red flag. WTI crude slipped to $58.35 a barrel.
And that's happening despite the fact that a Fed cut is coming, which should boost demand.
It should, in theory, but the weakness is being driven entirely by a supply glut that is just overwhelming any of those demand hopes.
Where is all the supply coming from?
You had the restart of a major Iraqi oil field, West Qurna 2, and then Saudi Arabia cut its official selling prices to Asia. The takeaway here is crucial.
Okay.
The stimulative effect of the Fed cut is being completely neutralized by this supply-demand imbalance. It really challenges the idea of a strong global recovery. The world just doesn't seem to be demanding enough oil.
Okay, so you have that red flag in oil. Now compare that to what's happening in precious metals. Gold futures rose to $4,240 an ounce.
Gold is playing its classic role. It's acting as a critical dual hedge for big money right now.
A dual hedge against what?
First, against monetary easing. Lower real yields make a non-yielding asset like gold way more attractive. Second, it's a hedge against all this systemic instability we've been talking about.
The geopolitical risk, the M&A drama.
All of it. If the Fed's commentary is even slightly dovish, analysts are predicting a quick push toward $4,300, maybe $4,500. It's the asset of last resort.
Let's move from these immediate market moves to the institutional future, because the long-term impact of this AI reliance is a huge deal. Central banks, like the Deutsche Bundesbank, are looking at adopting AI, but they face a massive governance challenge.
The opportunities are obviously vast. AI can improve their forecasting models, allow them to analyze huge new data sets.
What kind of data sets?
For example, the Bundesbank is using a tool called MELA, it's a language model, to analyze the tone and frequency of official communications from policymakers to predict future shifts. It's incredibly powerful.
But the core challenge is transparency, right?
Exactly. It's what's known as the model reliability and interpretability problem. Central banks, including the Fed, are built on public trust and transparency. Their decisions have to be explainable.
With these advanced AI models, they're not always explainable. The black box problem.
That's the issue. If they start relying on these complex black box models where even the policymakers can't fully understand how the model reached its conclusion, their accountability just collapses.
So if Chair Powell stands up and says, we made this decision because the model said so, but he can't explain why the model said so,
then the foundational trust in the institution is completely threatened. That lack of interpretability is a severe threat. It forces them into a choice. Do you prioritize the efficiency gains from AI, or do you maintain the accountability you need to govern in a democracy?
So let's try to summarize the core findings of this deep dive for you. This expected Fed rate cut, it isn't the end of a cycle. It's really just the starting line for what JP Morgan predicts will be a profoundly polarized 2026.
Right. The real story isn't if they ease, but how they talk about the future.
And that future pits this robust AI-driven boom against very clear signs of labor market fragility and that widening K-shaped wealth divide, all while these massive corporate M&A battles are being amplified by political intervention.
And if we tie all these threads together, from our reliance on AI for GDP growth to the institutional risks of AI governance, you see the ultimate challenge. We have AI driving these unprecedented productivity gains that produce more with less idea, which is what's supporting our future growth. But at the same time, that very same innovation is threatening the credibility of our most important institutions, like the Fed, because of the black box problem. So the real question is this. How quickly can governance and accountability methods, things like explainable AI, evolve to match the explosive pace of innovation before the foundational trust in our entire economic system is irrevocably fractured? That, more than any dot plot, is the defining question of the next cycle.